silver has just been classified or reclassified as a critical mineral. Now, into really very, very escalating geopolitical and tariff escalations, it's in very strong Russian and Chinese military demand. Now it's in US demand. I mean, basically, that's why we're noting record prices in every single global foreign exchange currency cross, prompting the US to both accumulate and the word is soon to ban exports of US silver. There's only one outcome to tightening supply. The offer to sell silver for immediate delivery is simply going to rise.
In a world increasingly shaped by competing monetary and geopolitical blocs, the race for real assets has intensified to levels unseen since the 1970s. The growing alliance between Russia, China, and India around physical commodities has redrawn the strategic landscape of global finance. As these nations steadily move away from dependence on the US dollar, they are consolidating their reserves in tangible stores of value: gold, silver, energy, and rare minerals. This coordinated shift has left Western policymakers scrambling for leverage. In response, the United States has quietly begun reclassifying key materials, most notably silver, as critical minerals. This seemingly bureaucratic decision marks far more than an administrative update. It signals a clear recognition that silver's dual function, both industrial and monetary, has become strategically indispensable in today's fragmented global economy. The geopolitical implications are evident. China and Russia have already restructured their commodity trade systems to bypass the dollar, opting for local currency settlements and increasingly anchoring their value in gold. Meanwhile, India has accelerated its bullion imports, aligning more closely with the Asian pricing hubs in Shanghai and Dubai. Against this shifting backdrop, Washington faces a new reality. Once regarded as a secondary asset, silver is now emerging as a cornerstone of both modern warfare and renewable infrastructure. From precision electronics and missile systems to solar panels and power grids, demand is surging across defense, energy, and technology sectors. According to reports cited by Andrew Maguire, the U.S. has already begun stockpiling silver and may soon restrict exports, a move that could instantly reprice global supply chains. The implications for precious metals are profound. Silver, which has long trailed gold in strategic importance, is rapidly closing that gap. With both Eastern and Western powers now competing for physical supply, the silver market, long distorted by synthetic paper trades, is starting to fracture. Prices denominated in foreign currencies are hitting record highs, highlighting how undervalued silver remains in US dollar terms. This emerging repricing isn't driven by speculation, but by the simple arithmetic of scarcity. As export controls tighten and industrial demand continues to grow, the inevitable outcome is a rising offer price for immediate delivery, precisely the trend Andrew Maguire warns about in his latest analysis. In today's video, we'll explore how this transformation is unfolding in the over-the-counter markets, what it means for central bank credibility, and why both gold and silver may be entering their most significant revaluation phase in decades.
Let's start by really looking at exactly who is on the hook here. The banks, along with the Bank of International Settlements, are all long for their own books. We've established that a long time ago. The only banks that are naked short gold are actually the banks that stick handle the Fed's short gold position. So it's important to understand that. No bullion bank is short for their own book. So what is it? It's the Fed. That's the only central bank still exposed to a net short derivative book. And while this is transparently evident in the hard-to-hide COMEX futures market footprints, where we can tie auditable monthly Fed repayments back to the BIS, as we have in every single episode we've tracked, the Fed being actually forced to buy back their short-sold lease borrowings into a series of higher prices. Now, it's the larger over-the-counter naked short unallocated bets in the OCC report that you refer to, which is where the real gold derivative problem actually lays. Now, every well-connected physical facing liquidity provider we deal with backs up our assertion and well-founded empirical evidence that these very, very large, undeliverable, unallocated, OCC gold bets. And remember, OCC just simply means the report that the Office of the Comptroller, and we've shown how suddenly the 5-year and longer bets were starting to be cut down, which told us, it was just one more thing that told us someone wanted to get out of Dodge. And so really, and it's these bets that are still outstanding is all that remains to so-called hedge these rehypothecated double ownership claims on a yet unknown percentage of the 8,133 tons of US Treasury gold. Or put another way, yet to be repaid US Treasury lease positions. We'll drill into the detail of how vulnerable to a forced gold revaluation this presents the Fed. And we're going to do that shortly, but the far more visible COMEX futures positions. Now, this is the spot market. So let's look at the futures market, which is really apples to apple. Every single month, we evidence how deep a hole the Fed has dug. Now, this is best demonstrated by the sequentially higher end of month and now yesterday's here end of third quarter mark-to-market event. This time, despite a massive effort to rinse out as many spec longs as possible into yesterday's end of quarter, we saw an attempt to rinse out. So basically, to try and mark that down, the bottom line is the Fed was forced to buy back deeply underwater gold leases at exactly $409 per ounce higher than they could last month. Now, given there's still 30 tons to buy back at market, it will drive the offer price to sell gold even higher. So if I'm a seller, I'm going to, and I see this demand coming through, then I'm going to raise that price. So currently this 30 tons is knocking on the door of $4 billion. That's just to square these smaller futures bets. But this size of at-market physical buying will once again reveal the buyer as the Fed, which brings us back to our assertion that a forced gold price revaluation is imminent. Now, the problem for the CME LBMA cartel is that the Shanghai Exchange International vaults are attracting legacy institutional ETF and physical flows out of Western control, skewing leverage futures overbought conditions versus underbought physically backed gold demand, and it's exacerbating this widening gulf. Now, Deutsche Bank's deep dive analysis here picks up on why ETF demand is outperforming all the legacy models that indicate overbought conditions. Now, what's not addressed is that the large-scale institutional EFP demand comes off a base where most of these ETF investors are buying gold off a zero investment position. They've never been exposed. They'd have no gold in their portfolio. They are starting out. This is huge. And obviously they're having to buy into the current physically determined Shanghai Gold Exchange benchmark positions. They face the Shanghai international side of that market. Now, hence, in this link, the aggressive interpretation. Also, as we'll look at, China has really cornered the gold market completely, stealing ETF investment flows out of the LBMA CME price setting machine. This very sticky physical gold demand is very supportive of higher prices. Now that brings us on to Lawrence's question as to the where are we with the gold price revaluation process that moved onto the front burner in January 2023. As we know, after the BIS reclassified gold as a high-quality liquid asset on the 1st of January 2023, every single global central bank, bullion bank, alongside fresh sticky inflows of institutional exchange-traded fund gold, followed the BIS lead and moved to go long gold, leaving only one central bank short gold.